Welcome, everybody, to the 12 Days of TMC. This is Rich Swerbinsky with the Mortgage Collaborative here with the opening session. See a lot of people getting logged on right now. We'll give everybody a moment to do so, and we'll go ahead and get started. Jodi, you in Cleveland today?
I am. I was on last week. I was at the farm in Southern Ohio. The house is completed. So
Oh, congratulations. I know that has been a long road to hoe.
the entire pandemic.
It's everybody has their, I became like a plant weirdo during the pandemic. You bought and built a farmhouse. So
Yeah, yep. Everybody has
well,
their own thing.
happy Tuesday, everyone. Rich Swerbinsky with the Mortgage Collaborative here with a very, very special edition of the 12 Days of TMC. Forgetting completely what's over my right shoulder, the biggest soccer game for the United States that just went live. It is also as the kickoff of the third annual edition of the 12 Days of TMC. We have way over 2,000 people registered as attendees for this event at the end of what has really been not a great year either for the mortgage industry. So a real testament. And this event, I always like to say, it really is at our core kind of who we are, a way to kind of give back to the members. We have just a slew of awesome sessions these next 3 weeks, all designed around making our members stronger. Coupled in with that are special editions like this one of our recurring shows and 12 awesome industry keynotes that will feature each day. And very notably, at the end of this show, at the bottom of the hour at 2:30, very, very happy to have the FHA Commissioner, Julia Gordon, joining us for the second session of 12 Days of TMC. Just 30 minutes from now, Allison Johnson from our board of directors will be interviewing Julia, Commissioner Gordon, and sponsored by our friends at National MI. But when we were deciding as a team, okay, opening session of the 12 Days of TMC, we're going to do it with a special edition of the Last Week in Mortgage today. Who do we want to have the co-host? And it was an easy and unanimous decision amongst our staff. One of our favorites, one of the real go-tos in our network that always answers the bell, gives so much of herself to the network, really well-liked, well-respected, and a Clevelander too, which never hurts. So, but the president of Nationwide Mortgage Bankers, Jodi Hall. Jodi, thank you so much for joining us for this special edition of
Awesome. Happy to be here. Much of the same sentiment. I think my answer to Angie on another session was hell yeah. So I feel and I had this conversation with my management team this morning because we are all in on the 12 days of TMC for the whole damn company. And you will only get as much out of the 12 days as TMC as you put in. If you choose to record a session, you're never going to go back and listen to it. If you choose to sit there silently and not participate, you're not going to get as much out of it as you're asking questions and engaging with everyone. So I encourage all of you to push your teams to participate. And I think that you'll get 12 days worth of information. And right now, what we all need to do in this market is to put our heads together and look for ways to contribute to the industry and to contribute to all of our sales teams that seem to, be hurting in this time and really lead through this. So, get active, roll up your sleeves and make this a great 12 days. And, kudos to TMC for putting it together and all of the other lenders and bankers that are part of the TMC family for their contributions and helping us learn for the next 12 days.
Very, very well said, Jodi. And, I know there's a lot of virtual everything out there, and the link is in the chat to our agenda. Take a look at the quality of some of the speakers, again, starting with Julia Gordon, FHA Commissioner, here in about 25 minutes, and the sessions these next 3 weeks. Save some, add them to your agenda. Even if you're listening in the background, doing something else, knowledge is power. To Jodi's point, this is a time where everybody's really sharpening their saw as we head into a year with more promise. And it's just a chance to make yourself a little bit better and to interact and to listen to some pretty smart people in our industry talk about what's going on. So
for sure.
And, no shortage of news topics to discuss this week, Jodi, to get things kicked off here. In general, the news feed and news cycle has been much more positive these last few weeks. Mortgage rates have dropped. Again, sensationalistic headline, biggest drop in 40 years, but it's helping. Every little bit helps. We've seen the MBA purchase application index go up now a couple weeks in a row. October new home sales actually beat expectations. Can't remember the last time I've heard that. And then we get this news that started to kind of percolate about a week ago. That's not in the good news camp, but related to the increased cost of FICO scored joint credit reports, almost doubling, going up 91%. Started with kind of like the reseller credit reps, leaking it to customers of theirs like you, and now some people have come out and put statements out about it. Start things off with your reaction to that breaking news story.
I think when I saw 400% potential increase this morning, I nearly fell off my chair. So I think it is, the closer we're getting to the new year and hitting the increases, I think that it is definitely, it's a shock, because usually we hear of like our vendor increases for, we would hear like at least in November, like what percentage of increases we would see from the credit reporting side of things, that we would see it much sooner. So it's coming out late. At least it feels like it's coming out late, not giving people a lot of time to pivot. And it also is interesting that the timing of it. So we had the announcement of potentially going to Vantage Score, and going to the FICO 10T, T10, whatever it is, and having alternative credit. And then all of a sudden the bureaus are going to increase. I think the most shocking part of it is the fact that it's going to be, the percentage of increase is basically going to be on tiers, and being on tiers based on what your production is. I think that we have felt over the last at least year and a half that there was more of a lean toward IMBs, recognizing that IMBs, contribute to the lending to underserved communities. And this is going to hit IMBs hard with being able to compete on the costs that they are passing along to the clients. And some of the clients, like you say, you know what, so, somewhere between $6 and $8, it's not going to impact, but it's everything. Everything is going up, and those costs are not going to be able to be absorbed by lenders. We saw in, we have was it $600 and some average loss per loan in the industry, $11,000 cost to originate a loan. And it's just every single cost is being passed on to that consumer. And at some point it's a breaking point. So it's like a lot of pent up anxiety is all of a sudden just like.
And I think that's my biggest just concern with this. Again, running an organization that is mostly small to medium-sized mortgage lenders, is that it's a slippery slope. There are lots of other settlement service providers that are involved in a mortgage transaction. You have to imagine they're looking at this like, oh, wow, it's not been a good year for us either. We can raise our rates, especially those like FICO that are in very strong competitive positions to not lose business. And to me, it really just is a slippery slope. And I think for that reason, was this a goal by United States? No, just missed. But I think for that reason, you're going to see the CFPB immediately get involved in this, if I have to guess, because they're rightfully so concerned about affordability, and now you have something that's touching every mortgage loan, basically saying, hey, we're doubling our pricing. Not only that, they went as far as to say, hey, the top 46 biggest lenders in America, they're only going up 10%. Then there's this second tier of 6 magical lenders. I don't know how it has its own tier, but they're going up 200%. Everybody else 400% was what I read. So it seems like, and that's almost thumbing your nose at the CFPB, the way I see that.
Yeah, I don't understand a lot of it. I will be interested, and I challenge Allison in her interview today. And also, I'm not sure who is interviewing Sandra Thompson, but to definitely get their take on the increase as well, and it coming so late. I guess on the positive side, well, I'm not sure there's much positive side on that, but it's almost like we're trying to shrink the IMBs. We knew like in this market that there would be a cleansing. We knew that there were going to be tons of mergers and acquisitions, but it almost feels like, all right, well, we got the snowball going. So let's see how many more small, mid-size IMBs are just ready to throw up their hands. And because the large IMBs are the winners.
Yeah, and I think honestly, you have leaders in housing in America right now that don't want that to happen. They don't want the biggest lenders to get bigger. And I think they see the value in small lenders, medium, large size lenders like Nationwide Mortgage Bankers. And the advantages that just gives home buyers when they have more options and choice. And again, this whole tiered structure where the smallest lenders are going to see the biggest increases. It flies in the face of everything this administration on the housing side has been talking about. And I think it sets the table for probably some sort of statement from the CFPB relatively soon, once they figure out like what they can say and what they can do, and then some attempt to try to reverse it. If you're FICO, you can kind of see where they're coming from, right? They've had this monopoly forever on, tri-merged credit scores, and FHFA has now come out and said, hey, we're going to introduce a second score. And by the way, Vantage Score is jointly owned by the three bureaus. So they're not lumped in with FICO here. They're just as invested in Vantage as they are FICO. And FICO's, and Sandra Thompson has also said it's going to take probably a couple years to fully implement the second score. So FICO's looking at this as like, hey, we got 2 more years left of a monopoly. Yeah. And we're going to go
get what we can get it.
I mean, I'm just, again, I'm not speaking on behalf of the Mortgage Collaborative. I'm just, I look through the lens of reality, and this is the way reality looks to me right now.
Yeah, for sure. It'll be interesting to see where others follow. And I do think like from running mortgage companies, like we're looking for, and I know we can't control like from FICO, but we are looking for vendors who are willing to share in the pain that we're experiencing now. They shared in our fat bellies in 2020 and 2021. So it's not as much like it's from the cost to originate. It's a very small percentage, but the way in which that is going to be communicated from vendor partners is going to be extremely important. Are they willing to bear the brunt of not as much of a margin to them? And so that, maybe that cost is 350% instead of 400%, but definitely something we're keeping an eye on with credit providers as well.
This is a special 12 days of TMC kickoff edition of the last week in mortgage today. I'm Rich Swerbinsky with the Mortgage Collaborative. Happy to be joined once again in the co-pilot seat by the president of Nationwide Mortgage Bankers, Jodi Hall. Any questions, comments, feel free to drop them in the chat, the Q&A, and I've seen a couple come in. We'll get to them in a moment. Before we do that, though, Jodi, another piece of big news just broke right before the show. Something else we've been expecting. The conforming loan limits, always raised around this time of year, around the end of November, beginning of December, increased by exactly the rate of appreciation year over year. Q3 of last year, Q3 of this year, 12.2% increase. That brings the 1 unit limit in non-high cost areas for loan sales to Fannie and Freddie, $726,000. I never thought I'd ever say that, at least not this in my mid 40s. But alas, here we are. Your thoughts on this latest piece of breaking news?
It's good for us with the markets that we're in with, pushing those high balance loans continuously. So it's good news for us as a company. I really didn't think that I'm going to stop trying to predict anything that is going to happen, because I really was worried about, not worried about, but was feeling sorry for some of the executives who pulled the trigger back in September to go ahead and start lending at the higher limits, because I thought that there was a chance that they might not be as high as anticipated. But, it is home investments, it's a win-win, right? Like even with high interest rates, even with soaring costs of origination, this is an investment that people are going to win on. And I think that, continuing to see home values increase, seeing limits increase is just re-verification that home buyers will continue to be in the market, continue to purchase homes, and continue to invest in what will probably be their largest investment and largest asset that they end up having into retirement. So it's like, it's a win for the industry, and it's as much, just because it's good news and there's been so much bad news, like it seems like greater news than, hey, we just increased the loan limits 12%.
Is Nationwide going to be the first lender in America to sell a loan over $1 million to Fannie and Freddie on Jan 1? I mean, like the funding advice, you might be able to like resell that on eBay. That's history.
Sure would like to. Do like to be first,
And the lending limits it's only on in high cost areas. There are some high cost areas where you can go as high as almost 1.1 million on a single unit sale to Fannie and Freddie. And Jodi mentioned you guys do a lot of business in New York. Definitely some high cost counties up there.
Yep, for sure. And with the, I haven't looked. We may have one that is near $1 million. I haven't looked at the high cost areas to see where that's at, but good news and good for the morale of salespeople in very high loan amount territories.
In the chat question, since inflation is nearly controlled, I don't know if everybody would agree with that. I hope the questioner is right, but when the Fed might lower the interest rates, I think the Fed right now, Jodi, is just battling this dilemma. Like, how much do we keep pushing? I don't think we're out of the woods yet we're starting to see some signs of abating. It just seems like they don't even know what the hell's going on, really.
I don't think, do we have some economists on the 12 days of
We
TMC?
do. We got Doug Duncan from Fannie, who's one of the best that will actually say what he's thinking, and that,
I'll let him answer that question. But from it was interesting. I read today that people felt as though the mortgage industry was in a recession in June. And I don't think that we're going to see inflation come up. We need more pain. And I don't think that the feds are just going to miraculously start lowering interest rates until we see the job loss, we see more job loss. I think, Black Friday, for those who celebrate that holiday, was shocking. People came out in force buying. I think that we have a little bit of, we saw coming out of the pandemic, people had built up funds and they were throwing money out. I think the reverse is happening right now. People are worried about what things are going to cost in the new year. There's the threat of the railroad shipping, the railroads to go on strike and not have access to goods. So I think that there's a lot of buying going on right now, as thinking that they might not be able to purchase something in the not too distant future. So until there's more pain in people's pockets, they still have historically high savings accounts, and people are spending money. And until people really feel the hurt and stop spending money, I don't know that we get inflation under control. But I do think it is interesting for the industry, the kind of thought that, we have been experienced like record high job loss, with companies shutting down and layoffs. So I think that we have hurt worse in the mortgage industry early on. And then the effects of other industries will start to feel that, but I don't know how far out it is till we can see the reversal in rates. So
you make a great point. The Black Friday spending stats were ridiculous. And I've been talking about this all year. I feel like the pandemic has just changed American spending habits for most would argue the worst. I mean, Americans are we're spending money right now into the face of inflation. But to your point, I think there is some of that element of like, hey, I'm not too certain about what the future holds. So if I need to buy X, I'm going to buy it now, as opposed to holding off. And I think we're even starting to see that a little bit. Even this drop in rates. I mean, it was to about 6.5%, but it did push some people off the fence, right? I mean,
Yep. Yeah, we saw a little bit of a increase in mortgage applications, but this is go back to the housing market happening in advance of other industries. Remember when we hit the 5%? And everybody feared that interest rates were going to continue to rise. So we saw a little bit of a blip on the radar from increased applications between the 5 and 6%, because people were afraid, hey, we're going to go at 6, 7, God only knows what percentage. So we saw people, if there is inventory, we're willing to buy up for it until we got to that, like into the 6s and even to the 7s. Then we saw applications start to die off. So I feel like that happened ahead of Black Friday for the buying part of it. So, but that 7% is like such an emotional hurdle. And it was decreased applications when we went over it, even though people needed to buy homes, decrease. And then as it goes below 7%, we see increased applications. And right now, I think we talk about emotional reactions to things. And I think that's largely an emotional reaction to, this might be as low as they go before Fed increases again. What are they going to do? Hopefully that continues, but I hope what we have seen is we've hit the high and it starts to come down. But I also think that this market has also scared some of the sellers out of the market, because it's like, what is the timing of me selling my house? I'm not going to get 6 offers on my house as soon as I put it on the market, and I need some place to live. Is there going to be other inventory? Am I going to be paying 7% or higher if I go to find another home to purchase? So it definitely is a lot of, it's really just mental and emotional, like guessing, because we're guessing. Can you imagine like a home buyer who knows nothing about the industry is like, screw this, I'm not guessing, I'm just going to sit and do nothing.
Very well said. This is a very special 12 days of TMC kickoff edition of the last week of Mortgage Today. Rich Swerbinski with the Mortgage Collaborative. Happy to be joined by the president of Nationwide Mortgage Bankers, Jodi Hall. As a reminder, in 7 minutes, we'll be interviewing FHA Commissioner Julia Gordon. The link will drop into the chat for that next session. But obviously, she was on the rundown with Rob and I a couple weeks ago. It was great. She was not your typical, just canned talking point, stuffy housing leader. She was very candid and funny and insightful. And anybody that's not seen Julia speak, and she insisted, call me Julia or Commissioner Gordon. It's just from one of the Superman or movies. We had a lot of fun with it. So she'll be good at the bottom of the hour and the kickoff of 12 great days of content here on the 12 days of TMC. Jodi, it's funny, you made several great points there. One is how time and events can change people's perspective, and what 5% on a 30-year fixed rate, how it would have made people feel and react last fall or even this past winter, and what 5% would look and feel like to potential home buyers in a month from now or 2 weeks from now or 2 months from now. And you made another great point that a lot of people have forgot about. One of the little volume pushes we got this year was when rates were going up into the 4s and the 5s. I remember looking at the MBA purchase application index during those weeks. And it's like, as we got that rise up in rates, we got like 5 or 6 weeks where purchase apps went up. I think you're right about the appearance of 7% and the aesthetics of it. And, even 6.5 or where we are right now. I think if we can get rates, once lenders can start to promote 5.5% or even a 4.99 30-year fixed rate, I think it's going to I think it's going to spur a lot of home purchase activity on the seller and the buyer side.
Yep. Yeah, absolutely. The other thing you think about too is, like someone our age, like my first home was 7.99% was the interest rate on my mortgage. So I also think that the given age of the majority of mortgage professionals, it's also an emotional hurdle for them. Like, wait, like we haven't seen this, for I won't tell you how many years, because I don't want to give away my age, but I think it's an emotional hurdle for all of us as well. What's interesting, when I was prepping for this, I looked back at our 12 days of TMC last week in mortgages and what our notes were. And it was Omicron helping mortgage rates more than the Fed is hurting rates. And the 10-year treasury was at 1.67% pre-Omicron and fell as low as 1.34% the week before we had this call a year ago. Boy.
It's funny. Every time you co-host this show, major news breaks, like within hours. It's the conforming loan limits, the FICO thing. But it's funny, a year ago, how much has changed.
Yeah, I mean, we were talking about that. We were talking about faster Fed tapering. The housing inventory has never been lower. So we're still low. I mean, we still have low housing inventory. That hasn't changed as much. And then the pending home sale rebound sharply in October, despite rising mortgage rates. Rising mortgage rates, to think about October to December last year compared to what interest rates are this year. It's mind-blowing to look back at some of that stuff. And one of the other things was a 2022 prediction you ask. And I don't know, I typically write notes, and I didn't write a note there. I think I wouldn't predict last year either. So I'm not going to predict the year ahead. What I'm hoping for is I'm hoping that Santa Claus comes down the chimney with 4% interest rates, with an increase in housing inventory, and every vendor that is out there that we pay to originate mortgages drops their cost 50%.
From your lips to some higher powers' ears, that would be a great Christmas present for the industry. Yeah. And if indeed that were to happen, I've been talking. There is to me such a shadow group of people that want to buy homes, and also sellers that don't have a home listed right now, for a bunch of reasons. I just think it could free up so much. And again, we got to get there. It's largely rate driven, which is largely inflation driven. It's why, we spend time on these calls talking about the topic, because we're trying to inform people, right, that are talking to customers or talking to employees about, what lies ahead for our industry. And love it or hate it, this is an industry where so much of the outcome of each year is out of our control. If it's regulatory, if it's interest rate driven, if it's geopolitical or broader economy stuff, we're forced to adjust to it all, and to kind of shuck and jive, and based on what's going on.
Yep. Adaptability.
Absolutely.
Survival.
Well, we're going live to Julia Gordon in just a minute here. One last question quickly to kick things off. Just the recruiting climate in general, how that's changed in under a minute throughout the course of this year. I know you're out there and you guys have been growing like crazy this year. We'd just love to end on your perspective on that side of our business.
I think that companies who are willing to make huge financial contributions based on 12 months of data for sign-on bonuses are greatly regretting it, because we're looking at a much shorter time frame and what that means today, because it's drastically different than a 12-month look back. But people are still looking, but everybody is inundating. So it's based on recruiting's based on relationships that we have had for years are what's coming to fruition, not the phone call from a recruiter that knows very little about the company or knows very little about the individual that they're reaching out to is worth working in this environment, because loan officers and branch managers are getting hundreds of phone calls a week from individuals like that. So it's relationship based, and people we've known and created a relationship with over the years who are willing to make the jump to you.
Very well said. And as always, Jodi, outstanding stuff. Always appreciate you answering the bell, especially for this special kickoff edition. And to our attendees, thanks for joining this kickoff edition. We go to Julia Gordon. Great 3 weeks of content, and appreciate you kicking things off with us. And Jodi, thanks again. And you're only 20 minutes from me, so let's get together for a couple adult beverages sometime soon here.
Love it. Let's do it over the holidays. Thank you all.
Thank you all. Enjoy the rest of the day
days.
in 12 days, and go USA.